Oh, merry stock market. Oh, man. Woo!
I love that so much. Welcome back to Strongman Personal Finance. My name is Christopher Belly. I'm a certified CPA accountant. I'm a long-term boglehead investor. I'm author of the book Stop Being a Broke Loser. It's on Amazon. And we're going to go look at some 10x stocks. And these are completely new stocks, ladies and gentlemen. That's right. Because at the end of the day, I need to provide you, my audience, with some value. And I'm going to show you how freaking hard it is to find a 10x stock. So we're going to go on Fidelity, and they have a pretty decent stock screener. We're going to put in a bunch of inputs, and we're going to go stock by stock, and we're going to see if we can find a potential winner. Now, I want to focus on stocks that are at least hopefully profitable, that have been recently wrecked, and that have decent cash flows and decent PEG ratios. So we're going to go look. We're going to see if we can find a 10x stock, and I'm going to show you it's freaking hard, okay? It's just, you just go on Fidelity, you screen cheap stocks, and then you just find a 10x stock, bro. It's that easy. So let's go on Fidelity, my Elity. And we'll see. So can y'all see my screen? Okay. So we got our stock criteria here. Okay. We're going to start with market capitalization. I'm only going to look at mid caps, small caps, and micro caps. Okay. Because, everybody looks at large caps. Everybody looks at mega caps. I don't want to talk about the same stocks that everybody else does. You want those hidden gems that people aren't looking at. And I'm sure there's a lot of hidden gems in the micro cap scene. We'll see. All right. Security price. I wonder if this tells us, okay, I don't care about the price. Let's close that. The price doesn't matter. It's the price that you're paying for the future earnings. So I don't care if it's a stock under $5. It doesn't matter to me. Security type, sector, industry, no. Dividend yield, I hate dividends. I wonder if I could do no dividend yield. No, we won't do that. Just in case, because, if it pays a tiny dividend, I don't want it to be excluded. Let's do PE. So I'm actually not huge on the PE ratio. I mean, it's a good initial screener of a stock. You can weed out stocks that are like super expensive. But sometimes PE ratios can be distorted. Maybe the company had a terrible 12 months in the past because of some kind of, impairment charge or, some kind of equity investment that went down massively. There's all sorts of reasons that a PE ratio could be skewed. And I guess using the PEG ratio too would kind of factor that in. But I'm going to use that anyway. So we want a low PEG ratio. Price to earnings over the growth rate. Okay. Let's see. So we got PE, price performance, 25 weeks. So I want stocks that have had negative price performance over the last 52 weeks, not 25 weeks. Because I want to find a stock that has massively dipped. That is a potential buying opportunity. So let's start investigating, why don't we? Okay. So what do we got here? We got Knight Swift Transportation Holdings, Knox. Knox my cocks. Let's go see what this is all about. Knight Swift Transportation Holdings. Let's see the performance over the past year. Woo, boy. Got freaking wrecked. How much is it down? Wow, it's only down 0.31% over the last 52 weeks. So not bad, I guess. Okay, provides truckload transportation services. Trucking segment. Ooh, isn't that really appropriate for this channel? Now, honestly, I'm not even going to touch something like that in this sector because right off the bat, they probably had some kind of massive explosion in 2021 with all the pent up demand. We had the lockdowns. Everybody came out of lockdowns. They wanted to spend money. And, the trucking industry probably went freaking crazy. So you can see right here, right off the bat, this company's freaking crazy, okay? You go back to 2016, they had $1 billion of revenue. 2017, they more than doubled their revenue. They must have had an acquisition. Then they doubled it again, and then it dropped in 2019 and 2020. And then, of course, a massive spike up. So a company like this that's like all over the place down 72, up 100. Right off the bat, I'm not interested. I mean, we can look at the margins, the trucking margins. Let's see. Yeah, they have pretty stable gross margins, until recently when they spiked up. But that makes sense because of all the pent up demand, stimmy checks, people coming out, trucking industry going crazy, delivering goods to people. Looks like they're buying back shares, profit margin, all over the freaking place. Yeah, I'm not touching that company. Because so you don't have to if you look at a company and you just don't like the industry or you don't understand the industry, you don't have to invest in it. Okay, next one, Huntington oops, zoomed in too much. Huntington Ingalls. So this is actually a pretty big employer in my neck of the woods. There's a shipyard. I live in the Virginia Beach area, or it's called Hampton Roads, and there's a shipyard out there. This is like a huge shipyard area. We build ships, maintain ships, whatever. So this is a big employer. Now, Huntington Ingalls, let's read a little bit more about it, engages in designing, building, overhauling, and repairing military ships. Exactly. We have a huge freaking naval base here in Norfolk. Ingalls Shipping, Newport News. That's like right down the road. And Technical Solutions. Okay, let's go check it out. So let's see how much it's gone down over the last 12 months. So it's basically flat over 12 months. I mean, it could be worse. Now, we look, and I don't think our military is going to contract anytime soon. I am not bearish on Huntington Ingalls. I think our military expenditures will continue to grow, especially as, the world becomes more dangerous or China continues to rise as a rivaling power. And we have Russia and the invasion. I don't think our military budget is going to be slashed anytime soon. So I'm not worried about this company's revenue growth. And you can see, I mean, they got they got decently consistent revenue growth. 5%, 10%, 8%, 5%, 1% in 2021. Let's go look at their shares outstanding. Looks like they're buying back shares. Okay. Gross margin seems to be shrinking every single year. That's very curious. I don't know why. Profit margin, 8, 4, 10, 6, 7, 5. Free cash flow margin, 7, 6, 6, 5, 8, 4. Let's go look at the balance sheet. Let's see how they're doing financially. So the first thing I want to look at is the current or quick ratio. That's a liquidity ratio. Basically, it tells you whether they can pay their short-term bills without going bankrupt. I don't think they're going bankrupt, but you never freaking know. So we have cash equivalents of 627 million, receivables of 400 million, inventory of 161 million, and other current assets, I don't know what those could be, of 1.5 billion dollars. You go down and look at current liabilities. Let's see. They got 600 of accounts payable, 651 of deferred revenue. So deferred revenue is when a company is paid in cash up front, but they haven't performed the service yet. So that doesn't necessarily mean that, all that's going to have to be paid out as a bill. It's just they got paid up front. And over time, as they perform the service, which is probably repair, do some kind of government contract, they'll recognize that revenue. So deferred revenue is a liability and other current liabilities. So you look at their current assets, they have enough assets, I think, to stay in business. I don't think they're going to go bankrupt within the next year. Of course, if you want to drill down more on what these other current assets are, you can. But if you look at their cash, they have $627 million of cash, and they have only $600 million of accounts payable. So I think they're going to be okay. All right, let's look at long-term debt. So what I like to do is I like to look at trends in long-term debt. So right off the bat, we see a pretty big explosion in long-term debt. Now, I want to see why they secured that long-term debt. Are they buying long-term assets with it, or are they financing their short-term operations? So you can look and you can compare long-term debt to long-term assets. So we can see property, plant, and equipment didn't really go up that much. However, goodwill and intangibles went up by $1.5 billion. So it looks like they acquired something, perhaps, okay? And other long-term assets. So it looks like they took out a lot of long-term debt to, maybe do an acquisition. We can check the statement of cash flows. I don't like that necessarily, especially as we go into a time of rising interest rates. But an industry like this, I mean, you got to remember, this is servicing the federal government, the military. I don't think the government, this is like probably a mission essential company. You know what I'm saying? They repair, probably build and repair submarine ships. I don't think they're going to go out of business personally. Okay. Let's look at the debt to equity ratio. So it's over 1. So more of the company's assets are secured by debt holders than shareholders. That's something to keep in mind. They took out a lot of freaking debt. Let's go look at the statement of cash flows. See what happened. Okay. So they have pretty consistent operating cash flow. Okay. On average, probably $900 million a year of positive operating cash flow. Let's see. Acquisitions. Yep. They had a $1.6 billion acquisition. What did they acquire? Let's go see. Huntington Ingalls acquisition. Let's see. Completed the acquisition of Allion Science and Technology. All cash acquisition. Okay, well, I guess, yeah, they borrowed money. They took out debt, and that's how they bought it. So it wasn't just they didn't have a bunch of cash on their balance sheet. They freaking went into debt to do it. We'll compare the division. Supports national security missions with unmanned systems, defense and federal solutions, and nuclear and environmental services. So if you're analyzing Huntington Ingalls, you got to factor in this company too. I mean, you got to do more. You got to do a ton of research. Let's see the ratios. P of 16, not crazy. Price to sales, 0.88. Price to books, 3. Price to free cash flow, a little pricey. Let's see. Debt to equity over 1. Debt to free cash flow, 10. They went into a lot of debt. And then they got decent returns. So this is something I would potentially consider doing some kind of analysis on. So what I would do is I'd go back here and I'd say, okay, boom. I'm going to do a check mark here, add it to my stocks, and I would do some more research later. Let's move on to the next one. So that's something that's something to put in my back pocket for another video. And especially because it's so close to home. I mean, actually, I even got like I get emails from Huntington Ingalls. They're like, hey, do you want to be a welder? Do you want to be a janitor? Yeah, I want to be a freaking janitor. That's right. All right, let's look at comments real quick. Let's see. Any interesting comments? Peg ratio? I'll peg you, boy. All right, let's keep looking. So Huntington Ingalls gets a potential reexamine. Next, we have, and this is what, like, if you want to find a 10x stock, I mean, you got to do all this freaking research. You got to identify a company that's interesting to you. Then you have to research the company, and you have to look at this. For Huntington Ingalls, you have to look at their recent acquisition. How's that going to affect future revenue growth? Are you worried about the debt? There's a lot of crap that goes into it. First Energy Corp. Let's see. First Energy. Now, if this has anything to do with gas, I'm not freaking touching this. Generates, transmits, and distributes electricity in the United States. All right, so it's a freaking utility. Let's see. They probably have an insane dividend. What is their dividend? 4.18%. I can tell you right off the bat, I ain't freaking investing in a utility. I mean, this is just kind of like what is their earnings growth? Earnings per share growth? Okay, this doesn't even show like all the details. I mean, you can see revenue is basically going to grow at the rate of the economy, so 3%, or maybe going into the future, probably 2%. And you got to adjust that for inflation, too. Remember, we've had crazy inflation. So the revenue is not even keeping up with inflation. Let's see, their gross margins, pretty consistent, high 39s, low 40s. Profit margin, man, they were losing some money back in the day. Okay profit margin. Free cash flow, not really that great. Lots of negatives. Let's look at their balance sheet. All right, cash and cash equivalents and receivables, almost $3 billion. Let's look at their debts. Let's see. Accounts payable, almost $1 billion, current debt, and then other liabilities. Not sure what that is. But you can look at their total current assets. They actually have a they actually have a current ratio below 1. That's something that you want to be careful with because I mean, I don't think this utility is going to go out of business. But whenever you see a company that has more current liabilities than current assets, you need to be wary because what that says is they have $4.4 billion of bills due within a year, but they currently only have $3.2 billion of current liquid assets or roughly liquid assets to pay those bills right now. So you need to be careful. Let's look at the long-term debt. Long-term debt, my head. So they got a lot of freaking debt. Holy crap. They got $22 billion of long-term debt and $10 billion of other long-term liabilities. And what is that securing? Mostly property, plant, equipment. Basically, yeah. Basically, so they don't really own any of their property, plant, equipment. They're just renting it, basically, or they still owe a lot of debt on it. So this is a very leveraged company. Now, remember, as interest rates go up, that could cause a problem. Okay, you might have difficulties with profit margin. Common stock, it looks like they're, I guess, flat. They're not really issuing shares or diluting that bad. Let's look at the ratios. PE 16. Okay, it's growing at 3%. That's probably too high. Price to free cash flow. Okay, they have like no free cash flow. Look at that. 78. Debt to equity 2.65. Woo! Debt to free cash flow 85. So this company is just going to be saddled with freaking debt forever. So it's got a stupid dividend, which I don't care about dividend. Oh, just buy a dividend stock, bro. No, I'm not doing that. This is garbage. In the trash. Sealed Air Corp. Okay, that just sounds stupid. Old Dominion Freight Line. I wonder if that's a Virginia company. Let's see if we can find an interesting one. Tell us, bro. Tell us, my Ellis. Let's see. Telus Corporation. Provides a range in Canada next. Let's go find a stock that's like dropped massively recently. Let's sort by stocks that have been freaking wrecked. Okay. Oh, God. 52-week performance, negative 88%. Loan Depot. Let me guess. They give out mortgages. Selling and servicing residential mortgage. Okay. I am not touching the freaking real estate industry. That is the last thing. Now, people might say, oh, well, this is probably the best time to potentially look at realtors or, mortgage originators because they've sold off so massively. And if the Fed ever cuts rates again, they'll probably be pretty significant beneficiaries. Okay, I don't know when that's going to be, but in the short term, no, I'm not touching this. Let's see. PE, yeah, the PE is super freaking low. I mean, these things have sold off massively. Dividend, 21%. That's probably because this stock got so freaking wrecked that their dividend is like insanely high. So let's go look at the financials. Okay. Yeah, look at this. This is no. Okay, when you see something like this, I'm turning my fan on. It's freaking hot in here. When you see something like this where their revenue goes from 1.3 billion to 4.3 billion, just stop. Don't even freaking go further, okay? That's something that you can't project. And what's most likely is going to happen is their revenue is probably going to revert to their mean, which is, in the low 1 billions. I wouldn't touch this with a 10-foot pole. See, there's a reason this company's cheap. But, oh, Chris, they have a low PE ratio. Nah. And it's a micro cap. PAG Seguro Digital. PAGs, my short rigs. What is this? Okay, PE 15, forward PE 9. See, this might be a Lafufu stock. Let's see if there's revenue growth. Okay, so Lafufu, here's all he does. PE my PP. And then you see the forward PE is lower. So he says, okay, the forward PE is lower. Analysts say buy. Beta is high. That means it's more volatile than the market. And he goes and looks at revenue, my revenue. I mean, that's some pretty revenue growth. Look at that. But once again, it looks like they had something is crazy is going on in 2021. Let's see what this company is. Provides financial technology solutions and services for consumers, small in Brazil and internationally. A digital ecosystem that operates a closed loop where clients are able to address their primary day-to-day managing and growing their businesses. It sounds like a bank almost. Maybe. I don't know. So it's like, oh, they help people manage their finances and they can send and receive funds and manage and grow their business. It's like, okay, you got a bank account, maybe some like, software where you can see, it's like a QuickBooks bank. That's kind of what it sounds like. I mean, on the surface, it looks attractive, but you also have to factor in it's based in Brazil. Do you understand the Brazilian economy? Do you understand the, what's going on in that country, how the government interacts with the private sector? There's a lot here, but I mean, I guess it's promising with the revenue growth, at least. Let's see, gross margins. Okay, they've shrank over the past couple of years. Profit margin shrank. It's shrinking almost every single year. Basically no free cash flow. Let's see the shares outstanding. They're issuing shares, but nothing too crazy. Okay, let's look at the balance sheet. So we got 26 trillion Brazilian reals. And we got, let's see, 19 billion or trillion Brazilian reals. So, they have a lot of receivables. They don't have much cash. They have a ton of receivables, which means, people owe them money for their services they've delivered. I don't know if that's normal. I mean, it looks like it is. But one thing you got to be wary of with something like this is if you have a ton of receivables and then the economy goes south, you might not collect as many of those receivables as you think. Because what the balance sheet shows is receivables net of the allowance for doubtful accounts, which means how many receivables the accountants and the management expect the company to receive. But if the economy changes and the accountant's judgment or the management judgment turns out to be freaking trash, that receivable balance might go off, be reduced significantly. So that's kind of weird right there. I mean, they have almost no cash. Let's see. They have, 2.5 trillion Brazilian reals. I hate these massive numbers. They hurt my head. And they have 14 trillion of accounts receivable. I don't know. I don't like that. Let's see. Operating cash flows all over the freaking place. At least it's positive. They have massive capital expenditures. They're probably, still in the growing pangs. What is their market cap? 3.4 billion? I guess that's okay. I don't like this. I'm really curious about this balance sheet. Like, what's going on when they have such a low cash position and so many receivables? I mean, it seems like they've been okay before, but with that much receivables, if you don't collect a lot of those and you got all these bills coming due with these accounts payable, you're in trouble. Okay, let me close this Huntington Ingalls. PagSeguro. So I'll pass on that one. I mean, we can look at the ratios. Okay, decent PE, I guess, for the growth. Nothing too insane. Debt, basically not much debt. Debt to equity. I mean, it's okay. I don't know. I don't understand Brazil, so I'm staying away from that one. Cricket my ticket. Now, before we do that, let's see if there's any comments. Whatever clownish comments you people have for me. Let's see. Oh, this guy. You realize that VT only exists because people invest in singular companies. If everyone listening to you, there wouldn't be any VT, you genius. I mean, yeah, that VT would still be there. It's just every company in the world. Like, even if everybody only bought the index would still be there. I'm shorting bonds. I think everybody's shorting bonds. I mean, you're probably a little bit too late to the game, man. Lufufu needs to finance 20x. He does, man. He's been freaking wrecked. Like a 96% loss. Imagine going from $100 down to $5. Yeah, you would literally have to 20x to get back to your initial investment. But it doesn't matter. Just PE, forward PE, revenue my avenue. We should send him this PagSeguro stock. Let him check it out and see what he thinks. Smith & Wesson. I don't like that stock. Political gambling stock. Let's see. This guy. I love trolls that talk about VT like, I don't know it's down or something. Your VT is down 23%. Admit there are other picks outside of VT. Of course, there's other picks outside of VT. Did I ever say it? No other stocks or ETFs exist besides VT? Oh, VT goes down. Oh my God. What? In mode. I'm telling you guys, there's something fishy about that stock. All right. If you don't know what InMode is, it's this medical device company that's based in Israel, I believe. And they have like the most perfect financial statements you could ever see. They have like no debt, growing revenues, profitable, they're like innovative, all these cool, new, exciting medical technologies. But their PE is like super low, and all their like financial metrics, their valuation metrics are low. It's like, why? Why are these metrics low? Are people pricing in massive revenue declines? Have they reached their peak? There's something fishy and stinky about that company that I don't like because it's just like too good to be true. You know what I'm saying? You got to be careful. Let's see. Look at bot. It's squeezing. Time for an 8-5. Okay, I'll look at bot. I think I remember you talking about that a while back. Bought my schlot. Pretty good, huh? See how clever I am? Almost as clever as Lafufu. Blue Hat Interactive Technology. What's the market cap on this thing? $27 million. Oh, revenue 15 million. Net income negative 57 million. Is this a joke? This is just garbage. What is this? What do they do? Blue Hat. Designing, producing, and selling animated toys with mobile game features. Okay, let's go look up this company. Blue Hat Interactive. Let's see what amazing things this company is doing. Okay. Home. Is a leading communications services and internet data center. Where did this toy thing come from? Oh, as well as it. Okay, so it has communications and internet data centers. And it also develops interactive entertainment toys and educational materials in China. That's like all over the place. Like, what is this? This must be a freaking joke. Okay, revenue, massive freaking decline. Let's see. Shares, obviously they're growing shares at a massive rate. They're probably losing money hand over fist. Profit. Wow, okay, this is like all over the place. Look at that profit margin. Negative 377%. Was that some kind of one-time charge? I don't know. This is like hot trash. Let's see. Cash and cash equivalents. They have $140,000 of cash. Okay. And I have more cash than that. And they have $20 million of receivables. So I literally have more cash in this company. That's funny. All right, let's see how much. So total current liabilities, 18 million. Total current assets, 21 million. And these receivables, it's like, how good are these receivables? Literally $140,000 of cash. That's freaking terrifying. Let's look at the quarterly. Yeah, dude, this is garbage. Are you screwing with me? Okay, please explain to me why you told me to look at this stock. You must be trolling me. Let's see. Do you reinvest your VT dividends? Yes. Also, is Intel a value trap? I don't know. I bought $500 of Intel. Is it a value trap? I don't know. I guess time will tell. I mean, I like the fundamentals. So I think it's sold off massively, but maybe it's a value trap. I can't tell you. The problem with Intel is I think the market's pricing in like probably flat or negative revenue growth going into the future. Because if the market wasn't doing that, I think that stock would be a lot higher. I mean, and people are also like, oh, NVIDIA and AMD are going to slay Intel and Intel's doomed. It's like, I don't know, man. I think they'll probably have some kind of decent revenue growth, even if it's in the low single digits going into the future. And if that's the case, I mean, I think it's going to be fine. Let's see. Tobacco stocks. Oh, I'm a fan. I'm a value trap when I'm working at the truck stop. Well, since you gave me $2, I'm going to dedicate and, use all of my knowledge and investing acumen to deeply analyze Hippo stock, because that's how cheap of a whore I am. All right, let's see. I remember looking at Hippo. I can guarantee you this is freaking trash. Market cap, $500 million. Revenue, $100 million. Net income, negative $243 million. So they lost 2.5 times their revenue in net income. This is that stupid insurance company, isn't it? Yeah, it's like this is a disruptive, innovative insurance company. Oh, man, they're just changing the world, bro. Yeah, it's freaking insurance, you clowns. Oh, but they got revenue by revenue growth. Let's see. Massive share issuance. I don't know if they went. It's probably because they went public. Let's look at the quarterly. Let's see. When did they go public? Hippo stock IPO date. Where is the IPO date? Where is the IPO date? When did Hippo IPO? August 3rd, 2021. So, okay. So it was within this quarter right here. Let's see. So the third quarter. And they had 387 million shares. And then it dropped to 272. And then now it's up to 560. There's some kind of glitch going on here. Let's go look at the statement of cash flows. Let's see if they issued shares. Okay. Shares issued. Okay, yeah. So they had a massive share issuance during the IPO. And then their share issuance has really slowed down. So, I mean, they're not diluting like crazy. But, I mean, like, look at these profit margins, man. I can guarantee this is trash. Negative 275, negative 189, negative 141, negative. Come on. Please. I'm so glad you gave me $1.99 to show me a stock that I will literally never, ever buy. I remember those days, too, when Kevin was pumping that stock and I was going after him really hard. Oh, boy. But, he's got 1.8 million subs. He must know something more than I do. I think Blue Hat is a perfect addition. Oh, that is the most trash. They have data servers, and then they make toys. I don't understand. Maybe I'm just stupid. I don't know. Look up Libd. Libd? Libd my Hibd. Lipped. Better be a 10x stock or I'm going to be pissed. Light in the Box Holdings. This sounds like it has a lot of potential. All right, let's see. Cross-border e-commerce platform that delivers products directly to its customers. So it's like a pissant Amazon or Alibaba. CEO is He Jian. What? Okay, $132 million market cap. Revenue of $427 million. They're profitable. Okay. PE of 10. Interesting. Let's look at the revenue by avenue growth. So it's got revenue by avenue growth. That's good. Decent growth. Shares outstanding. Nothing too crazy. Let's see. Gross margin. They're improving their gross margins every year. Okay. Profit margin. Very low. But if it's like an Amazon kind of thing, they're not going to have high profit margins. Free cash flow. I mean, it's okay. I mean, if they're a new business, they're going to have low free cash flow. I mean, this is, I don't know. I guess it's interesting. Let's see. $59 million of cash. Let's see how many current they have $109 million of current liabilities. Let's see. So they have a quick ratio and a current ratio of less than 1. So this company might potentially run into issues paying their short-term debts. And basically what that means is they're probably going to have to issue shares, because otherwise they're going to go out of business. Let's look at their long-term debt. So it looks like the long-term debt, $7 million. Property, plant, equipment, $14 million. Okay, well, they have basically $21 million of long-term liabilities and $14 million of property, plant, and equipment. So they've used some of that debt. They must have used some of that debt probably to do acquisitions. You can see the goodwill there. Let's see. Is their debt growing? Nah, it looks like they're paying it off. Let's see. Let's look at the cash flows. Okay, operating cash flows all over the place. Let's see. What is the difference here? Depreciation, amortization, share-based compensation. I mean, I guess it's okay to consider, but I don't know what their special niche is. They're most likely this would probably be like acquired by a bigger company. That would probably be the play here. I mean, the PE ratio is low, price to sales, price to books. My question is, why is this sold off so much? Why is this so cheap? That's my main question there. Light in the box. Light in the box holdings. What are you? We are a cross that delivers products from manufacturers to our customers. We offer customers a convenient way to shop. Okay, lightinthebox.com. Yeah, it's just like a pissy on Amazon, basically. Yeah, this is like Wish. Remember Wish stock? I mean, at least this company's profitable, but like I said, I think the main play for something like this would be if it got acquired. But this just kind of gives me like scam vibes. Like, when they have like the numbers, see the numbers here, and then they cross them out. I don't know. I mean, you'd have to do more research on that one. At least it has some encouraging signs. Like, let's see. Let's look at some more ratios here. Debt to they don't have a crazy amount of debt relative to equity. They don't have any free cash flow, so that debt's probably not getting paid off anytime soon. Return on invested capital. Woo! Negative. I mean, they are profitable. I mean, I guess you could look into it, but I don't know. This ain't my type of stock. If you wanted to put your money in the stock, you would definitely want to keep it to a very small part of your portfolio. It's got a market cap of $132 million. And it just looks scammy to me. But I mean, maybe there's potential. I don't know. That's kind of my thoughts there. Okay. WFG. Let's see. WFG. West Fraser Timber Company. Like, I can tell you, I'm not the expert on the timber industry. Diversified wood products, engages business marketing, lumber, engineering, wood products, pulp, and I mean, how directly tied? Hold on a minute. That name looks familiar. Did we just see another CEO named He John? Okay. I mean, my question with this company is how tied is it to the real estate industry? Because if the real estate market goes bust, in the next year or two, this company might suffer. But wow, it's got some profits. Let's look at the financials. Holy crap! Look at that revenue growth. What's going on here? I wonder if this benefited from the housing boom because of low interest rates and all that crap. Let's see. Gross margin, massive improvement. Profit margin, massive improvement. Free cash flow margin, massive improvement. I mean, on paper, it looks amazing, but the question is why? Why is it so amazing? You always have to ask yourself that. Let's see. Current assets, $3.2 billion. Current liabilities. Okay, they're not going out of business anytime soon. Let's look at so their total liabilities are $2.7 billion. And their cash is $1.5 billion. So, yeah, they're not going out of business anytime soon. I can tell you that. They're sitting pretty good right now. Paying off debt. Let's look at the statement of cash flows. Okay, net income growth, operating cash flow growth. I really wonder if this just benefited from the the whole, price increases in commodities and the whole real estate boom. Because what's going to happen is, if inflation starts to die down and commodities really drop, you could definitely see massive declines in profit and revenue from this company. Every company trades at a certain price for a reason. So, I mean, what's been the recent price action on this? Okay. When did this start booming? Man, this just went public. Okay. Interesting. Yeah, like I said, my main concern with this is if our inflation starts to decrease, how is this going to affect this company? And how much has this company benefited from inflation? Because that could really be factoring into the financials here. I mean, it looks okay. There's not a lot of debt. The revenue's growing. It's profitable. It's increasing its margins. I mean, it looks good, but look how freaking cheap it is. Why is it cheap? A PE of 2? What's going on here? But, I mean, interesting. I'm not going to knock it too hard. At least you guys give me some decent stocks, unlike that stupid blue hat. That was hot trash. Well, didn't Amazon go down by 95% because it had a stock split? All right, we'll look at Amazon, my schlamazon. Amazon, my schlamazon. I can tell you right now, I'm not a big fan of Amazon. Let's see. Why? Because it's got a very high PE. Now, like I said, PE isn't the sole metric, but it's like, if you have a high PE, you're factoring in some crazy growth, most likely. Or maybe you're like some kind of cash flow machine that isn't reflected in price to earnings. Okay, we all know what Amazon is. Let's go look at the ratios. PE is 55. What is the price to free cash flow? Oh, I guess they don't have free cash flow. They must be having massive investments. Let's see what they're doing. Because I know they have positive operating cash flow. Yeah, they're pumping some serious money into investments. Now, what are they buying? Maybe they're buying more warehouses. Maybe this could pay off. Maybe. But it's just the fact, like, with Amazon, it's a very low margin business. It's already had a massive freaking run up. I mean, this company has just grown and grown and grown. The main bull case I hear about Amazon is the AWS. So the question is, what percentage of AWS's revenues will be in this company, and how much of that profit will hit the bottom line at some point in the future? Because the actual core business of Amazon really isn't that profitable. But you can see 4, 5. I don't know. And I wonder how gas prices are going to be affecting their fulfillment expense, their shipping expense. So right off the bat, just seeing that price to earnings ratio of 55 and their revenue growth is 7%. I mean, if I was going to do an analysis, I would project revenues 5, 6, 7% going into the future. And I'd probably be conservative with their profit margins too. So, I mean, but there are some encouraging signs. I mean, they are pumping a ton of money into capital expenditures. I mean, like, holy freaking crap. So I would look into that. I would really look into AWS. And once you understand that and you can kind of model it out, maybe it's a buy. Let's see, how much is it down? I mean, it's sold off pretty significantly, but that doesn't necessarily mean it's a buy. This isn't a company I would touch, but I mean, I guess it has potential. I don't know. If you want to buy it, you can. I mean, if you buy VT, it's actually in VT. So I do own Amazon, just not in a concentrated position. You're welcome, buddy. The troll. He's not as money savvy as he claims, and he says stupid stuff like only invest in VT. When VT... You're such a clown, dude. I don't even know what to say. Let's see. IFMK is a 400K company. Yes, I'm going to cash out my 4. Actually, I probably don't even have 400K right now because all the stocks are down. I probably don't even have that much. Let's see. We'll go look at this real quick. IFMK. iFresh. You're right. I could literally buy this company. Or I could have. Let's see. What's the profit margin on this turd? Okay, so it had Okay, it's losing money. Let's see the balance sheet. Look at the most recent quarterly balance sheet. Okay, they got current assets of 32 million, and they have current liabilities of 50 million. I smell dilution. Total liabilities 100 million. Total assets 131 million. Let's see. Okay, so they have 60 million of long-term liabilities and 81 million of PP&E. So at least they haven't. It doesn't look like they've used long-term debt to finance short-term operations. Let's see. Cash flow. There's like almost no. What is this? Operates a network of grocery supermarket chains in the northeastern United States. Oh, did you know supermarkets provide vegetables, seafood, meat, fruits? Wow. iFresh. iFresh Inc. This is some crappy penny stock. Wow. Oh, wow. Look at that. The first Chinese supermarket group listed on the stock market in the. Okay, I am invested in Alibaba, but when it comes to like small Chinese companies, I stay far away. Asian Chinese supermarket. Okay, it's on the East Coast. I was about to say, like, when it comes to like Chinese penny stocks, no. I mean, I don't know. This is like, I don't even know what to say about this. A $400,000 market cap. Like, why did it sell off like this? Like something must have happened. Probably it's about to go bankrupt. You look at their balance sheet, and they don't have enough money to pay their short-term debts. They're going to have to issue stock. They literally have $750,000 of cash. That's it. Oh, wait, that's 2019. Wait a minute. Why is the annual balance sheet only going to 2019, but the quarterly goes to now? This is jacked up. No, I'm not buying this company. There's something really fishy, stinky going on here. And it's a freaking penny stock. Look at that. What's the share price? 1 cent? Pfft, get out of here. Pretty funny, though. Let's see. Here's the troll. Let me answer the troll, then I'll get to your stock, David. You have no right to lecture people on dumb investments. I love trolls. They entertain me. You lost at least $200K in a divorce. Then how does that have anything to do with investing? Then I got married again and had 2 kids. Yes, I got married and had 2 kids. You got me, bro. All right, IIPR. You got married. Duh, duh. You're stupid. I'm smart. I'm a fat single loser. Innovative industrial properties. Self-advised. Maryland Corporation focus on acquisition, ownership, and management of specialized properties leased to experienced state license. Okay, so they acquire, own, and manage cannabis facilities over the counter market. So it's a penny stock. Damn, look at those earnings. Woo! Okay. So it's got a $3.3 billion market cap. Okay, it's technically not a penny stock, but it sounds like one. Shares outstanding. Okay, they're profitable. Holy cannoli. Look at that revenue growth. Holy smokers, that ain't no jokers. Let's see if they're doing a lot of acquisitions. No, they're not. Well, I mean, they have a lot of capital expenditures. Where's that money coming from? Well, they have positive operating cash flow. Let's see. They're paying dividends. I mean, this is like a growth. Is this like really growthy? Why are they paying dividends? That's weird. That's something I would look into. I mean, they're growing so rapidly. Why are they paying out dividends? Shouldn't they be reinvesting that into the business? Okay. Issued a ton of shares in 2020. They're going into debt now. Let's see. Okay, let's go look at their margins. Okay, insanely high gross margin. Profit margin, decent. Yeah, for me, it's just hard to like really understand this company on the surface. Management of specialized properties leased. Okay, yeah, it looks like they're just buying a bunch of properties to use for medical use cannabis. Let's see. Ratios. PE, price to sales. I mean, it's interesting. Let's see. Don't really have a lot of debt. It's interesting. I'll give you that. I mean, there are some encouraging signs. Like they have massive freaking revenue growth. Like, holy freaking crap. Let's look at their balance sheet. Yeah, they don't really have. They barely have any current liabilities. I mean, this whole thing's kind of jacked up. Like, look at the data here. It's not really that great. You can see, okay, it says total liabilities, $472 million. This is the problem with using free software. But you look at, they don't have any liabilities listed. So I don't even know what to say. I can't even do an analysis of their balance sheet. Let's see. Debt growth. Yeah, something's off with this software. Retained earnings is more negative, but they had a profit. Okay, something doesn't make sense here. I think this data is jacked up. Yeah, I don't even know what to say. I mean, the data just doesn't say anything. I mean, it's interesting. I mean, you can see the revenue growth. I mean, obviously, the risk with this company is, regulatory risk. So that's something that you got to take into consideration. But I mean, I guess medical marijuana is legal. But another thing that I'm worried about is this: why are they paying dividends? If they're such a growth company, why are they paying dividends? And are they going to do another share issuance sometime in the future to acquire more properties? That's a massive share issuance they had in 2020, $1 billion. I mean, it's interesting, but I would have to do more research on that. Let's see. What's your opinion on SPR? SPR. Spirit Aerosystems Holdings. $3 billion market cap, $4 billion in revenue, negative 422 in net income. That better be a one-time charge, or I'm going to tell you I don't like it. Let's see. Designs, engineers, manufactures commercial aero structures worldwide. What is an aero structure? Forward, mid, and rear fuselage and systems. So I guess they make like parts of airplanes. They're in the aerospace and defense industry. They're traded on the New York Stock Exchange. Let's look at the financials. What is going on here? Look at this revenue, man. 6 billion, 6 billion, 7 billion, 7 billion, 3 billion, 4 billion. What is going on with that? Did they divest or did they lose some massive contract? Let's see. Shares outstanding, ticking up slowly, but doesn't look like crazy dilution. Negative gross margin. Why? Negative profit margin. So this is not a very high margin business, even when they were profitable. And now they have massive negative margins. I don't know if they're getting like impairment charges or what. Let's look at the balance sheet. All right. Total current assets, 3.8 billion. Total current liabilities, 1.8 billion. So they're not going out of debt anytime soon. Total liabilities, 7.2 billion. Long-term debt, 5.4 billion. And what is that secure? So they have $5.4 billion of long-term debt, but they only have 3.9 billion of long-term assets. That's weird to me. Why do they have more long-term debt than property, plant, and equipment? Like usually you use long-term debt to like finance property, plant, and equipment. Let's see. That's weird. Negative operating cash flows. Okay, they had a couple acquisitions. There's something going on really stinky with this company. I don't know. Like I said, I don't know if they lost a contract or what, but actually, let's go look. Okay, there was no divestiture. So that drop in revenue wasn't from getting rid of a business unit. I don't know what to say about this, man. This is very, you got to look into why this happened. And if this happened because of a contract cancellation going from $7.8 billion of revenue to 3.4, there's a lot of risk baked into this company. So that's all I can say for you there. All right, let's see. All right, guys, I'm not going to stay on much longer. So, I mean, you can send super chats if you love me, but I'm getting kind of tapped out on stock. So I'll do these last two, and then we'll probably call it a night. Oh, hold on. Let's see. All right, CE. What is CE? CE Maichi. Celanese. Celanese. Oh, it sounds exotic. Okay, they're profitable. Manufactures high-performance engineered polymers. Engineered materials, acetate tow. Okay, so it's just like a manufacturer. Interesting. It's profitable. Let's go look at some ratios. We'll do this real quick. Okay, it really hasn't sold off. Okay, it sold off pretty significantly from 2021, but what hasn't? Low PE, low price to sales, kind of high price to books, price to free cash flow, cheap. Debt to free cash flow, not crazy. High return on invested capital. Let's look at the revenue growth. Okay, once again, it's like odd. So they got hit hard by the pandemic, it looks like. Once again, I wonder how much inflation is impacting this company. Because look at the last couple of years. They had $7 billion of revenue, then $6 billion, then $5 billion, and then now they have $8.5 billion. Interesting. Excuse me. Profit margin. Yeah, this is probably a pandemic beneficiary. I mean, look at that spike in profit margin. Going from, 16, 15, 14, 13 to 22. I mean, it's not bad, but I'm really curious about this. This, random revenue just going up and down, and then revenue was declining from 2018 to 2019 into 2020, and then all of a sudden it spiked up. Total current assets, 3.8. Total current liabilities, okay, they're not going out of business. Let's see, anytime soon at least. Long-term debt, $5 billion. Long-term assets, $8 billion. And that includes $2 billion of goodwill. Okay, so it's not horribly, leveraged out. At least it looks like they use their long-term debt to buy mostly assets, like tangible assets, right? Operating cash flow growth, probably because of whatever happened in 2021, probably a pandemic beneficiary. Massive acquisition, $1 billion. $1 billion. Share issuance. So they had an acquisition and they repurchased $1 billion of shares. They must have had just a bunch of cash sitting there not doing anything. I mean, it's interesting. I wouldn't say it's a horrible company, but I don't like these spikes right here. I don't like it. 8 billion, 5.6 billion to 8 billion. All right. Let's do this last two stocks. People are killing me. Actually, this is the last two. Like I said, if you want to give me a super chat, great, but I'm done looking at stocks. I'm getting tired. Drive Shack and Airbnb. Y'all can see. Drive Shack, my nutsack. What does a Drive Shack do? Market cap 139 million. Massively unprofitable. Leisure and entertainment. Golf venues. Oh, it's a golf. Okay, it's a golf venue company. Interesting. Golf my Alf. Okay. Basically, you look in the past, they had flat revenues, flat, and they had massive declining revenues, and then the revenues spiked up in 2021. Is that temporary or permanent? Why were the revenues declining? What changed in 2021 to make the revenue go from declining massively every year to increasing? I don't know. Let's see. Profit margin, negative. Okay, so they've had 5 years of negative profit margin. You look at their free cash flow margin, only 2 years of positive free cash flow margin. Look at their balance sheet. Current assets, 100 million. Current liabilities, 110 million. but 36 is deferred revenue. Okay, so that's not too horrible. Let's see. Long-term liabilities, $342 million. Okay. Yeah, so it looks like they mostly use their long-term debt to buy property, plant, equipment, probably golf courses. Duh. So nothing too horrible there. Operating cash flow, negative, 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 finally positive in 2021 after a massive increase in revenue that may be temporary. Issuing shares. Okay, they don't have a PE. They're not profitable. Yeah, I don't like this. I don't know. Debt to equity ratio. Woo! Look at that. That's because they've been having so many losses. Their equity's got to be like insanely low. I don't know what there is to like about this, man. I mean, it's a freaking golf venue. I mean, okay. Let's see. And then we got Airbnb. Oh, Airbnb. Oh, boy. That's a tough one. Airbnb. Look at the ratios. PE 80. That's pretty rich. Price to sales 10. This seems a little bubbly to me. Price to books of 13. Price to free cash flow 22. It's a pretty pricey company. Debt to equity, not crazy. Debt to free cash flow, not crazy. Let's see. Income statement. Okay, well, I can see why they have a high PE ratio. So, I mean, obviously the 2020 is an outlier year, but they basically made up for all the losses in 2021. So they have pretty insane revenue growth, and I can definitely see that continuing to go into the future. I don't know how much competition Airbnb really has. I mean, what is their competition? Vrbo? I mean, the only thing I can think of to go somewhere is Airbnb or Vrbo. And I prefer Airbnb. Let's see, are they actually profitable? So they've been unprofitable, but it looks like they're getting closer to profitability. So you can see, they had negative 14% profit margin in 2019. Then they had a massive loss in the pandemic, understandable. And then now their profit margin's negative 5.88%. They have also very high gross margins, because obviously they're just a company that benefits from, people booking, rooms, and they just get a fee from that. They're not very like capital intensive. Let's go look at their balance sheet. Total current assets, 12 billion. Total current liability, okay, 6 billion. They're not going out of debt anytime soon. Total long-term liabilities, 2.5 billion. Long-term assets, 1.3. Long-term debt. What was this for? It was probably for an acquisition. Probably. Because you look at their property, plant, and equipment, they only have $420 million of PP&E. That's like probably their offices and crap like that. But they do have a decent amount of goodwill. So they probably took out some debt to make an acquisition is what I'm thinking. Or pay their bills. Who knows? Let's see. Cash flow. I mean, they have positive operating cash flow. That's good. Acquisitions. They haven't acquired anything in 2 years. Let's see. Share issuance. Okay, well, they had to do a massive share issuance in 2020. I understand that. And they did one in 2021. Let's see. Paying off debt. I mean, overall, Airbnb is definitely an interesting case. The reason I wouldn't buy this right now is it's very hard for me to value and figure out when it's going to become profitable. At some point, this company probably will become profitable. I have no doubt in my mind. So what you're going to have to do is really do some insane analysis and figure out what will the profit margin be in the following 5 or 10 years? How much is going to hit the bottom line? What will their free cash flow be? Then you have to discount it and figure out a good buy price. I mean, my gut tells me it's probably still expensive, but there is potential in Airbnb. I'm not going to dispute that. Okay. Well, I'm freaking tired. So thanks for tuning in. Thanks for all my grift tendies. But I am going to bed. Cheers.